Shares of Beyond Meat are collapsing on Wednesday after the market closed after the Wall Street Journal reported the company is talking with debtors to potentially restructure the company. That is code for going through bankruptcy. That's not exactly what's happening yet. Shares are down 16% as I'm recording in post-market trading, so we'll see where things end up on Thursday. But it doesn't appear that the future for Beyond Meat is very positive. And this is one of those warning signs that I think investors really need to keep in mind with stocks that are losing money and are relying on the market for more funding in the future. I know I always get a lot of pushback when I do articles about EV charging companies or electric vehicle companies that are burning through cash about how people love their products or electric vehicles are going to be the future. But just like with food, you have to have a business that fundamentally makes money. Yes, you can have a revolutionary product. People can even love your product. But if you're losing money on every single item that you sell, that is not a good business. That is not an investable business. And eventually, when the market loses confidence in your product, you're going to have to go through something like what Beyond Meat is going through right now. So I want to dig through exactly what we know about Beyond Meat right now, but think about this in the context of some of these other high-risk companies that are losing money. Because the stock market right now is starting to lose patience with companies that continue to lose money and don't show the ability to generate a gross profit, an operating profit, and eventually reach sustainability on their own without the need of the market. So that's a huge risk for investors, and the risk can be zero from a downside perspective. That's what I'm going to dig through today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's look at the market reaction first. This is Google Finance and the reaction from the market on Wednesday after the market closed. You can see here shares are down about 16%. They, for a period of time, traded down to nearly $5 per share. So we'll see where things open on Thursday. Sometimes this aftermarket trading can be extremely volatile. But here's the original report from the Wall Street Journal saying that Beyond Meat is engaging bondholders in restructuring talks. Lawyers for the company are beginning to talk to debt holders about restructuring the $1.1 billion that they are owed. And this shouldn't be all that surprising given the company's finances. Before we get there, I do want to note that at least as of the time I'm recording, there is nothing officially out from the company saying that they're going through any sort of bankruptcy or that they're actually talking to debt holders. So this is not official news from the company. This is news reports, but Wall Street Journal typically on top of these things pretty well. And if there was some sort of news or press release to come out, this would be something that would be likely a done deal. So what typically happens is you get a report like this from a publication like the Wall Street Journal, like Bloomberg, and then eventually, a few days later, you get some sort of either agreement or the company does end up going into bankruptcy. So why would Beyond Meat have to do that? I'm going to start with the high-level financials here, and these go back to 2016. These are annual numbers, and you can see that when the company went public, and back in 2020, 2021, this was a growth company that it looked like the financials were getting a little bit better. But over the last few years, you move to 2022, 2023, revenue starts to drop and those losses just start to explode. And this is really the fundamental problem for Beyond Meat, is that they're not only generating less revenue, but they're actually burning more money, but they're actually losing more money than they're generating in revenue now. So this is where you get to the point of restructuring. I'm not really sure what you're going to restructure because the fundamental costs of the business are just out of whack with any sort of value creation, no matter who owns the company, whether it's current equity holders or debt holders. If you look at the trailing 12-month numbers, you can see that the deterioration was pretty quick starting in 2021. Those margins start to get lower. Losses start to grow as revenue starts to drop. And there are a couple of signs that I think investors should really be looking for when you're looking at companies like this that are on that growth curve, but are on a little bit more of the risky side of the business. You can see that gross margins were actually improving pretty nicely through the year of 2019, stayed decent in 2020, and then in 2021 started to drop. And this was when I think you really started to see the company have to prove that it could actually sell through products. So when they expanded some of their distribution into grocery stores and all kinds of other locations in 2021, you actually generate a lot of sales from just building inventory in those locations. So Beyond Meat records a bunch of sales, but that doesn't necessarily mean that product is actually selling through into end customers. When you reach 2021, 2022, that's when you actually start to see how much our end customers actually demanding this product and willing to pay a premium price for it. And the answer is they weren't really at all. And that's fundamentally what you see here in the gross profit margin is actually negative. So that's a terrible sign for a product company that wants to sell you a plant-based burger over and over again. But they have to make money on each one that they sell. There's no network effect in this business. It has to be positive unit economics from the start. And that's fundamentally where the company went wrong. So these are the warning signs that you should be looking for. If a company can't make a gross profit, that's a terrible sign. If they're not improving their margins to the point where they can get to positive net income, positive free cash flow, that's something that you need to see for a business to be sustainable long term. It's typically only so long that a company can keep going back to the market to ask for more money, to raise more debt. And that's what Beyond Meat is facing right now. But that debt side is the other thing that I want to keep in mind, because there's a lot of companies right now that are losing money that do have debt on the balance sheet. And that is a different kind of risk than just a falling stock price. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is where things really went wrong for Beyond Meat. You can see that in 2021, they raised $1.1 billion worth of debt. This was a convertible note, 0% coupon, so it didn't actually cost the company much money, but it is a huge risk for the balance sheet, because if you eventually have to renew that debt, then that could potentially be very costly. If you look at the cash that's on the balance sheet, that is dwindling even as that debt number stays where it was. So this is the problem with leverage on the balance sheet. The irony is that Beyond Meat's shares were trading for $140, $150 per share when this debt was taken out. So they could have just sold stock and that would have been much more sustainable for the business long term. Now you get to the point where you have this debt on the balance sheet. The stock has now dropped to about $6 per share, and it's much harder to raise capital. This is the fundamental problem that these money-losing companies are going to face, is that you eventually have to go back to the market and ask for more funds. If you already have debt outstanding, it's going to be harder to go to debt markets. If your stock price continues to fall, it's going to be harder to go to equity markets. Eventually, you just run out of options, and you get to the point that Beyond Meat looks like it's at right now, where you have a money-losing business. It's going to be very costly to sell shares in the open market. It looks like, just the reaction today was at least 20% down at the low point. Wouldn't be surprised to see that again tomorrow. Debt markets don't seem like they're going to be open for a company like this. So restructuring is what they're potentially going to go through. Again, these are early reports from the Wall Street Journal, not something that we know officially what's going to happen. But if the stock price does fall on Thursday or over the next couple of weeks, the options are just very limited for a company that has far more debt than it has cash on the balance sheet. Eventually, something is going to break for Beyond Meat, because the fundamental business is not making money. And that's the most important thing to remember with all of these companies. If the fundamental business, if what you're selling every day does not make money, then that business is unsustainable. And you're relying in one way or another on either debt markets or equity markets. And once those start to close to you, the drop can be extremely quick. So that's what I took away from Beyond Meat today. Let me know what you think about this news in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.